invest for the right reason and not for the wrong reason. And the wrong reason is not to come here to make a quick buck because you're seeing everyone else make quick money, or the returns have been good, the past returns have been good, because past return now has no meaning.
Hello and welcome to Invest Smart, a show where we talk about all things related to your money, your savings, and your investments. I'm Avni Raja. On the show today, joining me is Neil Parikh, CEO of PPFAS, to talk about the budget impact on your investments and what's the way ahead for investors. Neil, thank you so much for taking the time out and welcome to the show. Let me start by asking you, I think one of the things which took most people by surprise was the hike in the long-term capital gains tax. What was your own sense? Because the way the markets have absorbed it is quite telling of the investor mindset.
Yeah, so thank you, Avni, for having me on your show. So I don't think this was completely out of the blue, in my
Okay?
opinion. I think there was some chatter around taxation changing, at least when it comes to the markets. So I think in the past few days, the RBI governor, SEBI chief, have also given some statements where you could have deduced that some changes are going to come about. So obviously this was because of the speculative nature of what's going on in the market, with FNO volumes going up, day trading going up, and the like, right? So obviously the expectation was something would change on the securities transaction tax and the short-term capital gains tax, and people thought that there could be a chance of long-term capital gains tax also getting increased a bit. But people were hopeful that wouldn't happen. But that didn't happen. So it didn't take people completely by shock, in my opinion. Yeah, I mean, the market has absorbed it. They've taken it in their stride, and yeah, it's continuing. So I think there's not much you can do, right, with taxes. I
Right.
mean, it's like playing cricket, right? I mean, two teams are playing on the same pitch. You don't decide the pitch that you're playing on, but you got to win the match. So it's
Correct.
akin to that. So I think we've all taken it in our strides, and hopefully we can make more gains to pay the taxes.
Right. So, Neil, from the point of view of PPFAS and for PPFAS investors and the funds there, what is it that investors should know in terms of the changes that they're going to be impacted with?
Yeah, so we've actually just yesterday we've come out with we've emailed our clients, and we've also put it up on social media that how the schemes are going to be affected in terms of the taxation. So we run very few schemes. There are only 6 schemes that we run.
Yeah.
So obviously those are 2 equity funds out there. One is a tax saver fund. So their short term doesn't really apply because 3 years is the lock in. So long-term capital gains tax will now be from 10 to 12.5%. Our flexi cap, which is our main equity fund, will again have long-term capital gains of 12.5 and short-term of 20%. We have we and Yeah. So the other main fund that we really have is the dynamic asset allocation fund, which is a hybrid category where we are very excited about this fund because with the debt taxation not being great. I mean, it's going to be taxed at your marginal rate of tax. I think what we're telling people that do your debt investment through a debt fund like ours, where we're running it like a debt fund, but it's in the hybrid space, and you will get long-term capital gains after 2 years of 12.5%.
Right.
It's not going to be taxed at your marginal rate. So I think that's a pretty interesting thing. I mean, obviously, it loses the indexation benefits that it had earlier, but I don't think it's too bad. If you want to invest in debt fund, then the dynamic asset allocation makes sense. Then the other funds are the liquid fund, which doesn't change, and the arbitrage fund, which will have the same equity taxation as the other funds, and conservative hybrid fund that we run, which will be taxed straight as a debt fund. So those are the kind of changes that are there in terms of
Right.
taxation. Otherwise, nothing else changes from our front in terms of the investment approach or the way we look at stocks, or how what we're doing. I mean, the budget is probably just one thing, and the election or something like that. So we don't really invest in terms of because of some event that's happened. So we have a bottom up stock picking approach, and that continues, so nothing changes on that
Right.
front.
Neil, now talking a little bit more about, the kind of change that we've seen over the last few years in the investors' mindset. There's been a huge spike, whether it's demat accounts, whether it's SIPs. So, in this entire scenario, how much would you attribute it to the fundamental change in the retail investors' mindset, and how much would you attribute to the bull market that we're seeing right now?
Yeah, so I think that you're right on both fronts. I think investors are getting much more matured. I think they look at equity investing as something for long-term gains or long-term goals that they want to fulfill. The SIPs are a great way. I think we are seeing the SIP culture building up, and I think that's amazing. And I hope that most of that money is sticky money. Because we've not seen a bear market or a flat market in a very very long time. It's been years or decades since we've seen that. So obviously the confidence is also very high in terms of the bull market. The bull market will obviously have its own thing, that people see other people making money, or they see people making money and they also want to make money, so they join the bandwagon. And sometimes people are here to make a quick buck. So there's that section of the people also who are doing the FNO trading, or doing the day trading, which is, I mean, if you're not too confident about it, or you don't know too much about it, or you're just buying things on tips or something, then I think that could end badly for people. But people who are investing systematically, who have a longer term approach to investing, I think I think they'll do great. Looking at the way India is going to progress in the next decade or so.
Now that both the big events are over, whether it's the elections, the budget, you said that your fundamental strategy investment framework doesn't really change. But can you give us some sense of what that framework is at the moment? Because we are at a place where the valuations are extremely high and warrants a bit of caution.
Yeah, so our investment process, I could break it up to five or six things that we look at, and which are important to us when we make an investment. One is management quality or the promoter quality, and that's really important today. If you're partnering with a company, you want that manager or the promoter to be honest, truthful, trustworthy, not doing shady stuff with the funds that you're giving them. So having an absolute good quality management is very important for us. Secondly, we are looking at stock investment as basically as a partnership, and not as just a stock that will go up and down. So we're looking at a long-term business trends in this. So if the stock or the sector has visibility for the longer term, and we think that this will be great for the next 5-10 years, then we're not really bothered what will happen too much in the short term. The price of the stocks go up or down. The business performance has to be good.
Yeah.
Stock performance will oscillate between sentiments of people. So but as long as the business performance is good and you have patience to hold on to that, I think we will be pretty well off for that. Thirdly, our preference is to buy cash rich companies, and not companies which are too much in debt or very debt heavy. What this does is, and we've seen that during COVID also, that if you have cash on your books, it's easier to make acquisition and grow your businesses. If you have debt and a bad event happens, then the business can be completely destroyed because of that. So that's another thing. Fourthly, we want companies which has some pricing power. I mean, we don't want very commoditized businesses. I mean, the only way companies will make money and you will make money is if the company will be able to price the product at a better way. I mean, if it's commoditized and the price keeps dropping, even if there's volume growth, the profitability might not be there. And lastly, you said valuations matter a lot.
Yeah.
We'll want to invest with there's margin of safety, and if there's no margin of safety, or things are looking overvalued, then we don't mind sitting on the sidelines for some time.
Right, right. So let me ask you this: for an investor who's looking to enter right now, perhaps somebody who's been waiting for these big events to get out of the way and now is looking to start putting money into the stock market, perhaps he or she has just started earning. What would your advice be? Because obviously, such a person has seen the returns that people around him or her have got over the last couple of years, and entering with those kind of lofty expectations, which obviously they shouldn't do. But what is your advice for such a person?
Yeah, first and foremost, invest for the right reason and not for the wrong
Yeah.
reason. And the wrong reason is not to come here to make a quick buck because you're seeing everyone else make quick money, or the returns have been good. The past returns have been good because past return now has no meaning. I mean, now we are look in the future. So one is that I would tell them to actually look at the risk profile, what they are comfortable in. If you're a risk averse person, that don't go too much into having too much of your capital into equities. Have a balanced portfolio, have an asset allocation in place, and once you have that asset allocation in place, have the patience to hold it for 5 to 7 years. I think today we are not in a market which is cheap from any imagination. I think we are in a probably a slightly more expensive market. So be careful about where you invest. People, first time investors should not be investing in thematic or sectoral funds. They should invest in either an index fund if they don't know what to do, or a diversified fund like a flexi cap or something that that invests over not in a theme or a sector, but in the overall market as such. Uh, Having said that, I mean, I think today the starting valuations are not cheap. So at least have a 7 year time horizon, and don't get jittery. Things will go up and down for sure. So just stay put. I mean, just being staying put for the longer term. I think I've seen lot more people making money than trying to do just actions. Sometimes inaction is the best action. So I think I would just tell them
Yes.
invest and forget about it for some time.
Absolutely. Neil, you mentioned right now, and even earlier, I was seeing one of your posts on X as well, where you said it's okay to underperform in this kind of a market. So, the narrative of FOMO right now is so strong, where people are constantly feeling that they're missing out on this bull market. They're looking for ways to enter. And that's the narrative that's really being built right now. Greed at its peak, if I can say. But it's so good to hear that voice of sanity and caution at this point in time. It shows that there is, the fund is value oriented, and perhaps the safest way for investors to remain in the market at this point. But my question is, do you think that we're at that stage when it's time to be fearful when others are greedy, or perhaps we've already been there for a while?
Yeah, I think markets have been a bit expensive for some time, and markets can remain irrational more than you can remain rational. So I think no one can say when the market will go down, or I'm not
Yeah,
even saying the market will go down. There are pockets which are looking expensive, and there are pockets of opportunity also. The thing is, the pockets of opportunity have not done well in the recent past, so they are kind of a neglected sector. That's the place that we've tried to find our stock ideas, or we try to invest there and have patience for that to turn. On the other hand, yeah, some of the space looks pretty heated up. The consumer names look
yeah,
pretty expensive. The small and mid caps have run away. So I think what I'm saying is that uh, have a little bit of caution right now. Also, if you've gone overboard in equity, it's time to rebalance a little bit if you can. And secondly, I think if you have some goals or you need funds in the next couple of years, it's not a bad time to start taking out a little money also right now.
right, right. So, how much cash is PPFAS sitting on at the moment?
So we are sitting on about 16% cash.
Okay.
And again, cash is, we don't keep cash by looking at the, say, the market level or something like that. I mean, our preference would be to be invested at all times, but sometimes it just happens that our best ideas are not trading at a valuation we are comfortable with, and we don't mind waiting on the sideline until we are comfortable buying, because I think the starting valuation of the buy price really matters for you to make future returns. So we are mindful of that, and that's why I said that maybe there could be some short term underperformance in the fund because of the bit of a cash position, and the market keeps rallying. But we're not really worried about it. We've seen this play out over the last 2 or 3 cycles. So
Right,
we are okay. We're okay. We're pretty patient people, so we're okay about that.
right. So, would you have the similar advice for investors as well? And I'm talking perhaps the slightly more mature or seasoned investors who put in maybe bulk into mutual funds, or who are buying their own stocks, to sit on a bit of cash right now.
Uh, yeah, I mean, one thing is that first and foremost, have a longer term horizon. So, if you want to be invested almost fully, that's all absolutely fine as long as your horizon is long. Don't get jittery if something happens and the stocks go up and down or your portfolio goes up and down. Don't sell at the wrong time. If you're not comfortable right now with the valuation, then it's okay. You can be a little bit in cash. I'm actually okay about people taking out some money and being in cash right now. So both ways are fine. If you're holding on, hold for a very long time. And if you're not that comfortable, it's okay to be about 10-15% in cash and wait for opportunities to come your way.
Right. So, Neil, right now, where would you say there are still pockets of value? Of course, like you said, a lot of the market is overheated, but where do you think pockets of value still exist?
Yeah, I think private sector banks are one place where we've not seen. It's a neglected space right now. I mean, again, the at least the private sector banks have not done that great over the last 3 or 4 years. And if India needs to grow and become a very big market or number two or number three market, then banks have to do well. So if that's your theory, then yeah, I would. Uh, we, we were pretty bullish on the private sector banking at least. That's where we find some value right now.
Okay, all right. So Neil, since PPFAS also invests in global stocks, US especially, India's growth potential is being talked about a lot right now, especially as a justification to the higher valuations. But if we were to compare with, say, US, some of the largest companies in the US are showing better growth than some of the largest companies in India, but are available at cheaper valuations. So how do you see this dichotomy?
Yes, that's been there for some time. I think some of the stocks that we hold in the US, which are the tech giants, the Google and the Facebooks and the
Right.
Amazons and the Microsofts. So these guys are in the forefront of all the changes that are taking place. It could be AI, cloud computing, again, from linear TV to online TV. All those things are there. So these companies are at the forefront of all those changes or the trends that are going forward. So one is that you can take advantage of those trends. They are growing really well. I mean, the profit, even though they are such big companies, the profitability is amazing. That it's more profitable than some of the largest companies
Hmm.
also, and also trading at a valuation which is pretty comfortable. So
Yes.
yeah, they do provide some opportunity. Unfortunately, we are not allowed anymore to put in more money in the as a mutual fund industry. We've hit the 7 billion limit, dollar limit, so we're not allowed
Yeah.
to remit more money outside. But I
But
hope
if you
that
had
will
the
be soon.
chance, would you prefer to put in more money into US right
Yeah,
now, into US stocks?
yeah. Our what we would prefer is 70-30 kind of thing.
Okay.
70% in Indian markets, 30% in, say, global markets. That would be the asset allocation that we are pretty happy with. Right now, our global allocation has come down to, again, I would think 16 or 17%. So I would think that, yeah, we would have probably upped that and got it probably close to 30%
Right.
if we had the opportunity right now.
The other question I wanted to ask you, Neil, is with regard to the new capital gain structure. Because from this new structure, it seems that mutual funds will have more of an advantage as compared to individual investors or even PMS funds, really. Because of, do you think it's going to now become even harder for an individual investor of PMS managers to churn capital as compared to mutual fund managers with this new structure?
Yeah, I think mutual funds have a great advantage by not paying taxes. We are a pass
Yeah.
through vehicle and we are tax exempt. So how many ever times the mutual fund buys or sells in the mutual fund, we don't pay any taxes. Nor does the investor pay any taxes. The investor will only pay tax once at the time of redemption. So what happens if you hold it on for a long term, like for about 10 years or something? The compounding really really works in a mutual fund. Compare that to an individual investor or PMS, which has to pay tax on every buy or sell
Yes.
transaction. That stops the compounding process. And if you have the same number of trades in a mutual fund or a PMS or an individual investor, and you get the same kind of return, the mutual fund would do much better over a longer term because they don't pay any taxes. So yeah, I think mutual funds definitely have a advantage going forward.
All right, Neil, we'll leave it there. Thank you so much for joining us and for sharing your views and thoughts as far as the current market scenario is concerned.
Thank you so much, Avni.